Many people who want to invest are often interested in dividend stocks. It's usually two camps. People want to invest in stocks or they want to invest in index funds. But with so many choices with dividend stocks, joining me now is Ed Rempel, fee for service financial planner and tax accountant with what you need to know about dividend stocks. Ed, thank you for joining me today at the Canadian Financial Summit.
Always great talking to you, Barry.
Okay, Ed, I'm excited for this presentation you've got prepared. Why is dividend investing so popular today?
All right, give me 1 second. I'm just going to actually share my screen here. All right, so why it's so popular today? Like it's been popular, but it's just the last few years it's actually gained quite a bit of popularity. And part of it is it's just the search for yield. Like we had quite a few years of really low interest rates and everyone's looking for higher yield, which brought into it. Today, the cost of living is a lot higher. So some people are using it as a supplement to their salary. How can I get a bit more income? There's the entire FIRE community. These people, financial independence, retire early. They're all looking at, not all of them, but a good chunk of them are looking at, oh, it's a way that I can get some income and maybe help retire early. I think COVID actually changed thinking a lot because a lot of people were home on COVID, and all of a sudden it struck me, geez, what would it take to stay home permanently? What would it take? I'm sure a lot of people had that thought. Right. So, and I need some other income that's gonna come to me. So the word passive income, everyone's talking about passive income all the time. And then a lot of people were the self-employed people were the ones that really took the hit in COVID. Like all the individuals pretty well got covered, but self-employed people got nailed. And a lot of them thinking, geez, I wish I had something else. And then, the other thing is the baby boomers, so 2023 is the peak retirement year. There will be more Canadians will retire in 2023 than any other year because there are 62, which is the baby boomers, the biggest group. And this is the age where they mostly retire. So they're all thinking of ways to retire. But bottom line is mainly for retirement, lifestyle, extra income, or it's, some emergency income. That's really what people are looking for.
Okay, so whatever your reason for having interest in dividend investing, what are the advantages?
All right, so this could be a bit fun because I have a very specific view of dividend investing, which you'll see in a second. But first of all, I'm just going to explain. So these are I put it in quote advantages because for the real dividend investor believers, these are the 10 reasons that they claim that dividend investing is so good. So first of all, you get paid to wait, right? Because you own your stock and you're getting these dividends sent to you. And then you can watch your dividends rise. And I always get a charge out of this because there's lots of this, like literally hundreds of dividend bloggers. And they're always bragging about, oh, I'm getting 3,000 a month of dividends. Now it's 3,500. I always kind of laugh at that. I'll tell you why in a minute. You're getting passive income. That's the big, talk these days. It's an inflation hedge. So unlike, fixed income, like getting a GIC or something, it does rise over time with, kind of with inflation. And the dividend investors believe it is the lowest tax rates. Also, a lot of them talk about you can get $68,000 per year in dividends with no tax. So that's beautiful if you've got no other income. They claim it's got superior returns. And part of it is they think, okay, you keep your shares. So you're getting kind of like you're keeping your principal and it's just extra income that you're getting. And then you're not selling during a bear market. So if your investments are down, you're still getting cash flow out of them, but you're not selling anything, right? So you're not making the big mistake in investing is to sell your investments after they've gone down and before they recover. So they say, oh, you're not doing that, right? And then if you take the dividends and reinvest them, you're getting compound growth on the dividends. So these are the 10 reasons that all the dividend investors claim are the advantages of dividend investing.
I like how you emphasize the word claim there, and you kind of alluded to this earlier, but why is dividend investing considered a brain fart? These aren't my words. I think you came up with this term, or is this the term you like to use?
This is the term I like to use. And it's actually quite funny because I think dividend investing, people have persuaded themselves that dividends are something that they're not. It's a brain fart. And so this comes up with, so here's my definition, the Ed Rempel definition for dividend investing. It's the odd belief that taking money out of your investments does not take money out of your investments. That's my definition of dividend investing. So, if you sell shares, it's, one pocket of your pants. If when dividend investing reduces the share price, it's taken out of the other pocket. But either way, you're taking money out of your investments. So that's why it's a brain fart. Now, I know everybody's thinking this is income, right? So it's a very ingrained thought. So I got to give it a little bit of evidence. So let me just show you what I'm thinking. So first of all, taking a dividend or selling a shares, for the same amount are essentially the same thing. So both are withdrawals from your investments. And if you think they're not, then so you notice that whenever you get a dividend, a stock has what's called the ex-dividend date. Okay, so that's the date. After that date, you don't get the dividend, right? It's whoever owns the stock on that dividend gets the or ex-dividend date is the first day after the dividend has gone. So those people don't get it. So, but what you'll notice is the stock goes down by the amount of the dividend. So if let's say you have a dividend, so I always say dividend equals selling shares. They're both withdrawals. So if you have a stock worth $10 and 100 shares of it, okay, and you get a 50-cent dividend, what happens is the shares drop in value to $9.50 per share. So on the ex-dividend date, the share price will drop from $10 down to $9.50, plus or minus whatever else is happening that day. So now what happens is, so with the dividend, you have 100 shares. You still have the 100 that you always had, but they're worth $9.50. So it's got 95. It's worth $95 plus you got your $5 of the dividend. Now, if instead of that you sell shares, then you have 95 shares. But if they didn't pay a dividend, you just sold shares. The shares would be worth $10, and you'd still have $95, and then you'd have the same amount of cash. So if you sold some cash and you get a dividend of the same amount, it's the same thing. Both ways, you have $95 in your stock, and you've got $5 in your cash. Now, if you reinvest the dividend, so reinvesting the dividend is actually the same thing as not having a dividend. So if you have a stock that doesn't pay dividends at all, that's a reinvested dividend. They're the same thing, except for tax consequences. So both cases, you stay invested. Right. So if you use a 50-cent dividend to buy more shares, what happens with a dividend? Now you have 105 shares, but they're worth $9.50. Right. So remember, so they paid out the $5. You bought 5 more shares. So this is worth $100, but you pay a tax on the $5 dividend. Now, if there was no dividend, you still have your 100 shares and you did nothing. It's worth $10. You still have your $100. So I get a real charge of all these people who buy this dividend reinvestment plan. So a dividend reinvestment plan, your dividend is paid out and it automatically buys more shares. And I thought, you know what? That's exactly the same thing as no dividend, except that you're paying a better tax on the dividend each time. So there's really nothing in a dividend reinvestment plan. It's just money being shuffled back, taking money out of the right pocket, and putting it into the left pocket. So that's really odd. So I know it is a real brain fart. You have to get yourself around thinking of it like this. So let me compare a dividend versus selling shares. Okay. So a dividend of 1,000 versus selling shares of 1,000. What happens? So first of all, both cases, your investment value goes down by 1,000. Your cash goes up by 1,000. Your tax for dividend, you're paying tax on the dividend, whatever the dividend tax is. And if you're selling the shares, it's a combination of a capital gain and the return of capital. So depending on how much that share is going up, you probably mostly get your return of capital and a bit of capital gain. And then the other one is the control. Who has control of how much you get? With dividend, the company controls it. They decide how much the dividend is and when to pay it, and they can increase or decrease it anytime they want. Or if you're selling shares, you decide. You decide how much you want to sell anytime. So you can choose that. You have complete control of it. Now, how do we get out of this brain fart? Because everyone's a dividend investor, keeps thinking they're getting this new money, and it keeps thinking it's an income. So the way you do it is, don't focus on the dividend. Just focus on the investment value of the account value. Okay, not the dividend. If you focus on, I have $100, I'm getting a dividend, and now I have $95 in the company, and if you think of it as a bank account instead of thinking of it as shares, then you're thinking of it correctly. You just think about the amount that's invested in there. So what dividends really are, they're a payment frequency. That's what they are. So, for example, if you've ever bought GICs, there's such a thing as a compound GIC. So GICs, you can get it so they pay interest monthly, quarterly, annually, or at maturity. So it's called a compound GIC, right? So it doesn't pay any interest until the maturity date. So, and that's so really what a dividend is. It's a quarterly paid GIC is what it is. While if it didn't pay a dividend, that would be a compound GIC, and it would grow, and you're deferring the tax this way. So it's a way of which you're choosing with a dividend stock. All you're choosing is a quarterly payment frequency instead of a compound payment frequency. But that's really the only difference. And just to show you that it's new money. So companies, when they give you money, your shares are worth less. And companies can do four things with money. They can pay it as a dividend. They can buy back some of their own shares. They can reinvest it in the business and grow, or they can use it to buy some other companies. All four of them contribute to your total return, usually roughly the same amount. So, growth companies generally don't pay dividends. Like Warren Buffett's company never pays a dividend, and therefore it just grows faster. They grow faster by reinvesting. And there is a big trend now to companies buying share buybacks instead of dividends. They're reducing the dividend or stopping it, and they're using the same amount of money to buy back shares. And that's a more you're still giving money back to investors. But now what happens, instead of getting a dividend, your share price goes up a little bit, and it's more tax efficient than the dividend. So it is a good trend actually that's happening. I think some people don't like it for some reason, but it's actually positive for shareholders because you're still getting money back, but it's more in a more tax efficient way.
Okay, so you talked about taxes a little bit here with dividends. You talked about how some bloggers are obsessed with the tax benefits. It's funny when you talked about that because I know exactly what you're talking about. We're a bunch of nerds. I think some people get obsessed with dividends, and that's okay. But you actually say there's a bit of a weird formula when it comes to dividends and taxes.
Yes. So this is how it shows on the tax return. And the taxation of dividends is actually kind of strange. You have to kind of understand what it is. And the reason is it's integrated with the corporation tax. Okay. So the companies pay you a dividend and they're kind of integrating the tax. So first of all, when you get a dividend, it's grossed up. So if you get a dividend of 10,000, it shows on your tax return as 13,800 of taxable income, and you're paying tax on at your whatever your marginal tax rate is. You're paying tax on 13,800. Okay, and the reason they do this is that gross up of 38%. They're trying to approximate how much the original income that the company made before it paid the dividend. They're trying to approximate that taxable income, and you're paying the tax on the income that the company originally made. And then there's a dividend tax credit. So you get a 15% of the grossed up dividend, you get a tax credit, okay, which is a 20%. It's a 20% money back. So it's not a deduction, it's a credit. Okay, so 15% of the 13,800 is 2,070. So instead of just like if you're in a 50% tax bracket, instead of 10,000 dividend, you think, oh, I just pay 5,000 tax, I get 5,000. No, you get 13,800 tax. You pay 50% of that number, right, which is 6,300. Then you get $2,000. You get a tax credit, but that's a 20% tax credit. So anyway, it's kind of a weird formula, and it sometimes gives you a little bit funny results in the net tax that you're paying. So now, just to be clear, this is what I'm talking about here is it's called eligible dividends from public companies. So if you're investing in the stock market, this is what the rules are. If you get ineligible dividends, so if you own your own company and you pays you a dividend, the rules are different. They're kind of the same, but their numbers are quite different. And also, it's foreign dividends. If you buy a company that's outside of Canada, it's different again. So this is non-registered investments in the Canadian in this Canadian stock market only.
Okay, Ed, you've talked about how taxes have a weird formula with dividends, and it's not all roses and butterflies here. What's the problem with dividend investing?
All right, so there are a couple of problems, and I read a lot of dividend bloggers, and I talk to a lot of dividend investors. So these are kind of the issues that they struggle with. These are some of the real disadvantages of it. So first of all, you pay tax on the income even if you don't need it. Okay, and this is actually why why I keep laughing at, the dividend bloggers saying, oh, I'm up to 3,000 a month of dividends and 3,500. I'm thinking, well, you know what? You're still working and you're not retired, but you're paying tax on all these dividends, but you don't actually need the money. Why are you paying tax on it? Right. So you pay tax on money you don't need. The company controls the amount and the timing and everything. You don't control it. Okay. It's hard to get the income that you want. So you retire, you want to get a specific income that you want to, this is the retirement income that you want. But it's hard to make your dividend. If you're just buying dividend companies, it's hard to get exactly the number you want. Companies control the timing of the dividends. So most of them are quarterly. So you don't get the same amount every month of dividends. Usually it's a high month and then 2 low months. So they don't come out evenly. The dividends are grossed up in that weird formula. By to 138%. So that means you reach the higher tax brackets and the government clawbacks of government benefits. You reach them sooner, and they're more effective. Now the high clawbacks, the clawbacks are actually much higher. And I'll just give you an example. For low income Canadians, let's say you're over 65 and you have no income other than dividends. What happens is you can get this guaranteed income supplements for low-income people, and normally it's clawed back at 50% of whatever you make. But if what you make is a dividend, 69% of your dividend, like 70% of it, goes to the government. I get $1,000 dividend, but my pension, my GIS pension from the government is reduced by $700 out of that $1,000. So it's a real disaster. These different, government benefits. Also, your diversification is limited. So if you're trying to buy dividend companies, they're mostly in a few industries. They're mostly utilities, telecom, consumer staples, and energy and financials. They're mostly these, steady, mature companies in certain industries. It's pretty rare that you're getting tech companies with any sizable dividend, the faster growing companies. Another one is all Canadian. So to get the lower tax rates, you have to buy only companies that are in Canada. And then you have this problem with, home country bias, which a lot of people talk about. Canada's only 3% of the world's stock market. So why is, a lot of dividend investors have all their money, their non-registered money in Canada. And, Canada does have a lower return than the global market or US market. So dividend investors, a big problem is they're often choosing stocks based on the dividend that they pay and not based on the fundamentals. Like when you buy investments, you should buy them based on risk and return and growth potential. And that's what you should be using, not buy them just because they pay a dividend or because it's a high dividend. And the big thing is a lot of times when, I find a lot of dividend investors, they're trying to get their about 3,000 a month. I'm trying to get it higher. So instead of, waiting till it grows, my investments grow, I'm going to buy stocks that pay a higher dividend. Well, those are often overvalued, or they're slower growth companies. So it's usually a mistake to buy companies that have higher dividends because they're usually not going to necessarily give you a total return that's higher over time.
Ed, I have to admit, when my younger days, when I first started investing, I was into stocks. I got all hyped up into dividends, and I bought one of those dividend stocks with a high dividend. And exactly what you're saying now, these are things I didn't know in the past. They were overvalued. They were offering a high dividend for a reason, which is basically they're bleeding cash. You know what I mean? So fortunately for me, it was not an expensive lesson, but what I'm getting at here is that these are just basic fundamentals that you're talking about, and it's so easy for someone who's new to investing, having that target. You said $3,000 a month, I need to get it. Just kind of ignore everything else. But that said, is there a way to perfect dividend investing?
Yes, there is a way to do it, and we can fix all the problems. So I call it self-made dividends. It's dividend investing perfected. So basically, we're going to keep all the advantages of dividend investing, and we're going to avoid all the disadvantages. We're just going to make it a perfect thing. That's what they do. So first of all, like, what are self-made dividends? Let me explain what they are. So it's a quirky name, but basically all you're doing is just selling a bit of your investments each month. That's all it is. Okay, so it can be every month or whatever you need, but just sell a little bit of your investment. So when you're retired, you just usually automatically sell a bit each month. You choose the amount. It can be automatic. Like if you have mutual funds, you deal with professional portfolio managers or something, it can even be automatic. So you get it on the first of each month. You only withdraw when you need the cash, and it's very tax efficient. generally more tax efficient than dividend investing. And the big thing is, so when you need cash flow, not income. And so this is a way when you're just selling a bit of your investment, that gives you cash flow, and you get it, you take it whenever you need it, and then you don't take it whenever you don't. So this is an important distinction. Cash flow is money that comes to you, right? Income is taxable money, right? So we don't necessarily want income. We want cash flow is what we want. So now an example is, let's say you've got $1 million of investments. And so the most effective way to invest is for the highest long-term reliable growth. You're looking for total return after tax long-term is the best way. So if you're focused on long-term reliable growth, the most tax-efficient investments are deferred capital gains. So not capital gains this year, but it's when you invest money and it just grows over time, and you sell a bit over time, but basically it's capital gains that you pay down the road. That's the most tax efficient, much more so than dividends, or more so. And then so you retire. Let's say you do this 4% rule give you a guideline. So you have $1 million, you take it 40,000 out a year. So you're retired now, right? So up till now, you've got no dividends. Your investments grew to $1 million. Now I want to take 40,000 out a year. So that's $3,333.33 a month. So I just have my investments automatically sell that amount the first of each month. And that's so you have complete control and freedom for the amount. You can change the amount and frequency anytime you want. And it's the lowest tax type of investment, like low of investment income. So lower than dividends. And it's the exact amount you want, and it's the first of every month, just like you want, and you've got complete control of it.
So how are these self-made dividends taxed?
Okay, so they basically are, it's partly the capital, like partly the money you invested, and partly a capital gain. So for example, you invest $500,000, and over time it grows to $1 million. Okay, and then what you do is you sell 40,000 per year of it when you retire. Okay, so this is why you're saving up. Now you're retiring, you get your $40,000. You want to take 40,000 a year out. Okay, now out of that 40,000, 20,000, like so half of it was the money you put in. Okay, so that's tax free. It's just your original capital, and 20,000 of it is the gain. So you see, half the money that you have is the growth, and half is your original capital. So the original capital is free, and the gain is taxable as a gain. But capital gains in Canada, only half of the capital gain is taxable. So 10,000 of it is taxable. So what happens is you're getting 40,000 a month of a year of capital, but only 10,000 a year shows up on your tax return. That's how it's taxed. Okay. So 40,000 dividends with self-made dividends, 10,000 is taxable. With ordinary dividends, 55,200 is taxable. That's what shows up on your tax return, with the gross up. But here it's only 10,000 is taxable.
Okay, that's very interesting. Now, we kind of slammed dividends earlier in the chat, but at the same time, are the advantages of dividends true? Tell me more about them.
All right, so this is that list that we showed before. These are the advantages of dividends that dividend investors claim. And I just show you, like, most of them I think are false. One of them is true. One of them depends. And so this gets a bit technical. I'm going to go through this fast, but I just want to show you why I think these are all false. So first of all, getting paid to wait, you're actually not waiting. You're withdrawing money. You're not waiting. You're withdrawing money every quarter, every few months from your investments. So you're not waiting at all. And watching your dividends rise as you get closer to dividend. So these first three, the second and third one are kind of true, but they're actually disadvantages. They're not advantages. So your dividends, as you get closer to retirement, you're watching them grow, but you don't need them yet because you're not retired yet. Right? So this is all, you're being taxed on money you don't need. And it's a taxable withdrawal, passive income. It's not really passive income. It's a taxable withdrawal, whether you need it or not. So you're taxing the income, even though you don't need it, and you need cash flow and not income. So these first three, they're disadvantages, not advantages. So when the first one's not even true. So now the inflation hedge, that one is true. It does rise. Over time, dividends tend to rise. by, I don't know, inflation, or at least something like that, while fixed income doesn't. But, that's true of all stock market investing. It's not unique to dividend investing over anything else. So the 200-year return of the S&P 500 is 7% over inflation. It's basically when inflation is higher, the return is higher, and when it's lower, it makes lower. That's basically the long-term return. So, inflation hedge, all stock market investing generally is an inflation hedge. There's nothing unique here for dividend investing. Now, dividends are not the lowest tax. Again, so this one's false. So here is, except the one brief case. So these are the different tax brackets. So this is 2023 Ontario. And so this is Canadian dividends. Here's the tax rates where they are. So you see it's pretty low tax for low-income people, lower incomes. And actually it's negative tax, believe it or not, if you make $53,000 or less. So it's a very low tax just in here. But when you get to a bit higher income, they're taxed quite high over here, right? So remember the global US, if you buy US stock, it's all taxed like this. It's taxed exactly the same as interest. Now, self-made dividends, notice it's green here all the way through. You're always paying low tax on it. Now, the first you're paying 5% instead of -7, but basically you're paying low tax all the way through. And so what I've assumed for self-made dividends, because here this depends entirely on how much your stock has gone up. Because if you have some money invested, it hasn't gone up at all yet, it's just invested, then when you're taking money out, there's zero tax on it. All you're getting is your own money back, right? And this assumes that your money has doubled since you got it. Those are the tax rates. But notice it's, here they're about the same. Here they're much lower. Only for very low income people is dividend investing a bit lower. But for vast majority of people, dividends, self-made dividends are taxed less. So, and now after you're retired, it's completely different. So these are the tax brackets after you retire. So notice for dividends, it's for people making $20,000 or less with I make nothing else except dividends, it's my only income. They're actually paying 62% tax on dividends when you're low income dividend person after you're 65. Then you got a small gap where you're paying negative tax, and then you get into medium, and then it's high tax again. So now self-made dividends, notice it's green all the way down. No matter how low or how high your income is, you're never paying much tax on it. It's always quite selective. So again, it's the lowest tax. Self-made dividends are the lowest tax for almost everybody, and especially for seniors. So basically, if you're a low-income person, you should avoid dividends after age 65, because look at that 62% tax rate. That's a real disaster. So now this is the claim is it can withdraw $68,000 per year with no tax. So here's the truth of it. So in the federal tax, it is you can get $68,000 of tax of dividends with no income tax, but you do pay this. It's called alternative minimum tax. So you actually pay $2,000 of tax on it. Now, everybody pays federal tax plus provincial. So on top of that, the $68,000 number is different in every province. Some of them it's really low. Manitoba it's only $35,000. Ontario it's high, $100,000. But if you got $100,000, you actually pay $8,000 or $9,000 of tax on it. So your tax isn't zero on it. So the $60,000. So first, that tax isn't zero because you pay the alternative minimum tax and you pay some provincial tax. So an example, if I get a $65,000 dividend, so you're below this number. I'm in Ontario, I should get $65,000, but you actually pay $3,000 of tax. It's 5%. So you don't pay any federal tax, but you pay $1,600 of alternative minimum tax. You pay $643 of provincial alternative minimum tax, and then you pay $750 for this Ontario health premium. So you actually pay $3,000 tax on it. So it's not actually tax free. And then here's all the exceptions. So the rule they always say is if you have no other income other than dividends, you can get $68,000 tax free. Well, that assumes that you're single because and under age 65. So it assumes a whole bunch of other things. So if you're married and your spouse is claiming you, like you could no other income, they claim you as a spousal deduction, they would lose 28% of their spousal deduction. So basically a 28% tax. You don't pay any tax on it, but your spouse pays 28% tax on it, right? So, and And if both of you get only dividends, then you're paying $2,800, $3,000 each in or sorry, the alternative minimum tax starts at only $3,000. So it starts really low. You're paying alternative minimum tax. And if you're over age 65, there's a 69% clawback on your income. So this rule doesn't apply for single people and over 65. It doesn't apply in your RSP. It doesn't apply if the investments are in your corporation, because dividends inside a corporation are taxed at the highest rate at 50%. So, and basically, it's not true for retirement income because of the guaranteed income supplement, the clawback. So, number 7 about returns. So, different investors think it's higher returns, but it's not. And so a lot of times you'll see them comparing the dividend index in Canada to the overall index, but it's not really the real comparison. What you should compare, because dividend investing, you're only investing in Canada, so you should compare dividend stocks in Canada to the index globally or the US, because if you're not doing dividend investing, you can invest anywhere, right? So you should compare the Canadian Dividend Index to the S&P 500 or the MSCI World Index. That's what you should really compare. And then you'll see the returns are actually quite a lot lower. So, and even if you compare within one country, like, Canadian Dividend Index versus the Canadian Stock Market Index, it varies. Like sometimes one's a bit higher, sometimes a bit lower. And basically it's up and down. The dividend index tends to go up and down less in both directions. And there is a reason why dividend investing has done well the last several decades, but it just recently has done worse. And I think that is the new trend. And I explain why, because it's something called a bond bubble. I'm going to show you for a second. So from 1982 to 2020, we had 40 years where interest rates went from 20% to 1%. And that made bonds look like they were good investments when they're normally not. And so it benefited all fixed income. But, to the extent that people buy dividends because of the income, which again, it's a brain fart, but that's what people buy it based on that, right? So to the extent that they buy it based on the income, dividend investing looked good for 40 years, and that's good. And I think it's going to be worse after this. And you can actually see that in the charts. So this is Canadian dividend index versus the TSX. Okay, and you'll see that the index dividends is the red one, the pink one, and the blue one is the broad index. So broad index, they're basically keeping up with themselves. And notice just the last couple of years, since 2020, the dividend index has fallen off and the regular index. So you see the bond bubble thing has kicked in, and dividends have started to do less now than they were before. So this is comparing the dividend index here, that's again the pink, with the world index and the S&P 500. So if you're not focused on dividends, you can buy anything. You can buy any stock. So then the returns, this is $10 going to 30, but instead it went to 45 or 60. It's much higher returns when you go outside of Canada than sticking with the dividends. And this is even just in the US. This is the couple of the US indexes versus the broad market. So you see the broad market goes up more and down more. These are the dividend indexes. So basically it makes less, moves less in both directions. But because the market, goes up most of the time, it's probably going to lag as a general thing. And I'm just trying to show you this bond bubble. So this was, from 1800 till now. Those stocks have a nice consistent 7% return after inflation. But so bonds, they had a 40-year period where interest rates went from 1 to 20, and bonds did horrible for 40 years. And then the last 40 years, they went from 20 to 1, and bonds had quite a good return. So the last 40 years for bonds are probably going to be better than we're ever going to see in our lifetime. So, and then to the extent that index fund or dividend stocks are invested based on that, they have that same kind of a weird thing. So, and also, so in index or all-star investing tends to beat dividend. You're investing globally, you're investing based on fundamentals, you're buying, you're investing for the highest long-term real return, not for based on index. And basically what we do in dividend investing really is like index investing, except it's a smaller universe. You just arbitrarily excluding the non-dividend paying stocks, right? So in the US, 75% of stocks pay dividends. Globally, it's 53. In Canada, 95% of the stocks pay dividends. So it's almost exactly the same. And you should follow Warren Buffett's advice. Just be agnostic about dividends. Just pick the best stocks. Don't care about whether they paid in dividends or not. In Canada, the TSX 60 is 60 stocks. 56 pay dividends. Only 4 don't, and 2 of them, Shopify is quite a good one. Interestingly, is we invest with these all-star fund managers, and I looked at it a couple of years ago, and to see out of all the stocks they own, we're all over the world, in the U.S. There was only one stock in Canada, and it was Shopify. It had a great run, and it's the one that's not a dividend stock. So, and the last three, okay, dividends are withdrawals from investments. So you keep your shares. It's a principal. Well, there's no such thing as principal when it's equity investing. Remember, you got to think about your total investment. So you're still withdrawing money, and you are still selling during a correction because you're taking money out of your investment while it's low. So that's false. And dividend investing, you're not compounding. Dividend, reinvesting the dividend is the same thing as not having a dividend, right? It's exactly the same thing. So these 3 here are just logic errors, just brain farts of dividend investors. So there's my view on which was true. So out of the 10, 8 are false. 1 is true, but it's true of all stocks, and then 1 kind of depends.
You covered a lot of, you did a lot of fact checking when it comes to ordinary dividends, but I know you like to talk about self-made dividends. Let's compare those to ordinary dividends. Put them head to head for me.
All right, I'm going to put them head to head, right? We're going to keep all the advantages, get rid of all the disadvantages. So here's the head to head. So first of all, with self-made dividends, you decide the amount of the dividend you receive. You can start, stop, and change it anytime you want. You're not forced to pay tax on dividends you don't need. So if you don't while you're saving up for retirement, you probably don't want to pay tax on any of it. Just let your investments grow, right? So you don't withdraw anything. You don't pay any tax on it. You'll get some capital gains on your investment, but basically you can pay the least amount of tax. You're not withdrawing anything. So you can invest properly based on risk and return and total expected long-term growth instead of chasing yield. You can properly diversify globally instead of just in Canada. You can avoid buying expensive investments just to get a higher dividend. The clawbacks of government benefits are way lower. They're 5 to 6 times higher with regular dividends than they are with self-made dividends. You pay less tax than on ordinary dividends for almost everybody, and sometimes no tax. Now, the lowest tax type of investment income is deferred capital gains, where you're paying the capital gain in the future. And self-made dividends are just powered by deferred capital gains. And it's giving you cash flow, not income. The cash flow is what you really want, not the taxable income. So now let's fix all the problems with dividend investing. So remember, we had the 10 problems with dividend investing. So and the 10 problems are the things when you read dividend investors, I think they struggle with. So here's how we fix them all. First of all, you pay tax only on the income if you don't pay tax on the income if you don't need it. You only pay tax if you do need it. Do need the income. You control the amount. It's easy to get the exact amounts you want. So when you retire, you pick the exact dollar, even to the penny, what you want each month, and that's the amount you get. You control the timing of it. It's easy to get a regular monthly income. Taxable income is not grossed up, so you only pay tax on half the capital gains. So your taxable income is much less than the cash flow you get, instead of being much higher. There's very low clawbacks of government benefits. Generally 12% of GIS instead of 70%. Diversification is unlimited. You can buy anything you want. You can invest globally with no home country bias. You choose stocks based on all the fundamentals, risk, return, and growth potential. And it's unlimited choice for higher dividends because you just pick any stock you want and you just sell a bit more of it each month, right? So those are the 10 problems with dividend investing. We just fixed them all, and we still have all the advantages of it. So here's where, when I compare them, self-made dividends, ordinary dividends, here I have 10 different factors here. Lowest tax superior returns, decide on the amount. Income does not change unless you change it. Decide frequency, stop trying to change it. The tax on the income you don't need. Diversify globally. Low clawbacks of government benefits. Cash flow and income. 10 to nothing for self-made dividends. So when you compare them, actually, there's basically, I don't really see why anybody would buy ordinary dividends. There's kind of almost no case where it actually makes any sense versus self-made dividends. So, and this is why we say self-made dividends are better than ordinary dividends in every way.
Whoa, that is a lot you've covered, but guess what? We're going to talk even more dividends, right? Let's talk about life of self-made dividend investors versus ordinary dividend investors, because there can be a lot of differences.
Yes. So this is kind of fun. So from reading, dividend bloggers or talking to people that are dividend investors, this is kind of what their life is like. So saving retirement, they're proudly claiming how much they're getting in dividends, but they're paying tax on the stuff they don't need. They reinvest the dividends, which means they're paying tax and they don't even need the cash flow. They pay tax on dividends every year. They're tempted to spend some of that because they're getting all this dividends. They're tempted to spend it, which means you got less for retirement. And then they're investing, 100% in Canada. So this is what their kind of life is like. That's when they're saving for retirement. And once they're retired, then what happens, the income is usually too low for the desired lifestyle. So if you look at the 4% rule as a guideline, so I want to take 4% of my investments out every year. Well, generally, most dividend stocks pay less than 4%. So they're getting less than they want. So now they have to sell something and invest in high dividend stocks. So they're kind of always struggling because they can't quite get as much as they want. The income goes up and down, like a high month to 2 low months, whatever it is. And then because they pay quarterly, most of them. And then there's no control of the amount. The amount changes. The company will change it. They'll stop it sometimes, or they increase or decrease it. They mostly increase them, but you don't control it. And then there's always this temptation to chase the yield and buy these high dividend stocks. Exactly what you went through, Barry. So when you're retired, you're trying to get a little more income. Crap, how do I do it here? So let me buy this stock. And so if it pays a high dividend, usually it's because it's a very low growth stock, or it's because it's a stock that is down a lot and didn't change the dividend yet, right? So that means after that it could change the dividend, or it's a company that's got a major problem of some sort. So usually overvalued. So. And then here's the life of the self-made dividend investor. You're saving for retirement, so your dividend is zero while you're building up for retirement, zero. And then, so it's funny, I have guys saying I'm paying $3,000, I'm $35,000, $4,000 a month. So for the self-made dividend investor, it's zero. Then the day you retire, it's $10,000 a month, or 10. I paid zero up until then, and then it's exactly the number what I want. They invest globally or in the US, wherever they want to invest based on fundamentals. And then after you retire, you decide on the exact amount you want. So let's say you're going to follow a 4% rule. You want a sustainable amount, but you choose the amount that you need. You get the exact amount. It starts immediately. You get the exact same amount every month. You have full control of it, and you can easily reduce it or increase it. Like if you have a side hustle or get a part-time job, or just want to spend less one year, you can just reduce it. You can increase it if you want to take a big trip or do a big renovation or something. So it's just, you have full control of it. So life is easy for the self-made dividend investor, but for the ordinary dividend investor, it's a struggle constantly.
Okay, so finally, why are self-made dividends a perfect fit for your life?
Yeah, they're a perfect fit because we do retirement plans. We've done them for literally thousands of people, and they're just a perfect fit because ideally this is what you want to have: 0% dividends up until while you're saving for retirement, up until you retire. Then you want the exact amount that you want after that. You want a sustainable income, so you choose what amount you want to withdraw, and then you can adjust it to make sure it stays sustainable. You can adjust it anytime you want. And so bottom line, they're the perfect fit for giving you the desired lifestyle that you want.
Okay, Ed, and can you summarize everything? I know we've covered a lot, but let's go over some of the top points.
The basic point is dividend investing is just a brain fart. It's, people think that taking money out of the investments isn't actually taking money out of their investment, but it is. But if instead of that, you do self-made dividends, which means you just buy investments, you buy them just for the total long-term growth, and focus on long-term capital gains. You don't care whether it pays a dividend or not. You just buy the best stocks, and then you don't try to get dividends. But of course, if you're investing in stocks, you're going to get dividends. But you just buy the best stocks, hold them for the long term, and then when you need some money, you just sell a little bit each month. There's ways to some of them you can do it automatically. And that's how you create the cash flow you want whenever you need it, and it's more effective than ordinary dividends in every way.
Okay, Ed, we covered a lot about dividends. I'm sure you've got ways to educate more people. You've probably talked about it on YouTube. Can you share your social channels and where people can find you?
Yes. Okay. So just and quick. So I have a blog. My blog's actually #1 in Canada for a financial planner. It's edrempel.com, just my name. Also unconventionalwisdom.ca because we're in Canada. I didn't get .com, so just .ca. But also, if you want to talk to me about potentially being a client, we have our free 30-minute consultation. It's edrempel.com/talk. I started up a podcast this year. It's edrempel.com/listen. And the YouTube channel is edrempel.com/watch.
Okay, Ed, thank you for joining me on the Canadian Financial Summit this year. It's been a pleasure.
All right. Always fun talking with you, Barry.
Okay, let me stop this.